Welcome to today's explainer. Okay, today we are looking at something literally every entrepreneur inevitably faces, but honestly, very few are truly prepared for. Think of this as your ultimate survival guide for pitching to investors and stepping into that boardroom with total confidence. You could have a brilliant idea, an amazing team, and a product that could literally change the world. But here's the hard truth. Without the financial fuel to back up that vision, even the absolute greatest products are going to fail to launch. Finance isn't just about boring spreadsheets. It's the actual lifeblood of your business. If you're preparing to pitch to investors, understanding how to talk about your money isn't just optional, it is absolutely essential for your survival.
To really get into the investor mindset, we need to start with a stark question that trips up countless founders. Why do profitable businesses still fail every single year? Well, when you're sitting right across from a potential investor, they already know that a lack of customers or a bad product aren't always the main culprits for a startup's death. You can have people lining up around the block to buy your product, you can even show a profit on your initial spreadsheet and still go under.
The answer, the high-stakes reality that every single investor acutely understands, is simply this: because they run out of cash. In the boardroom, the people with the capital know that understanding finance is the only real way to prevent this fate. They are looking for founders who realize that money management is hands down the most vital operational skill a business owner can possibly possess.
Okay, let's dive into this. We're going to follow a really structured roadmap today to translate your basic business operations into an airtight investor-ready pitch. 1. Speaking the investor's language. 2. The 4 financial foundations. 3. Proving your health. 4. Metrics investors interrogate. And finally, 5. Securing the ask. Let's get right to it.
Starting off with Section 1, speaking the investor's language.
When you step into that pitch room, you aren't just selling your product anymore, right? You are selling your financial acumen. And doing that requires actually knowing the vocabulary of money. The very first thing an investor is going to look for is whether you understand the fundamental difference between revenue and profit. We have to draw a really hard line here. Revenue is all the money your business earns. It's your top line. Profit, on the other hand, is the money left over after paying all your expenses. It is such a classic rookie mistake to confuse the two, or to walk in assuming that just because you've got more revenue coming in, you automatically have more profit. Investors will spot that misconception immediately, and let me tell you, it'll kill a deal way faster than a bad product ever could.
And this brilliantly illustrates the reality of running a business. Think of your revenue as the whole donut here. Every single cost you incur, from salaries to rent to marketing, takes a literal bite out of that revenue. What you have left, that smaller slice, that is your true profit. That's the actual wealth your business is generating. If you can't demonstrate exactly how you protect that profit slice from getting devoured by expenses, well, investors just aren't going to trust you with their capital.
Which brings us to Section 2, the 4 financial foundations.
To truly speak the language of the boardroom, you have to understand the core building blocks that appear in almost every single financial report an investor is ever going to scrutinize. Let's rapid fire through these 4 foundations, because mastering these simple definitions is the absolute first step toward proving you know what you're doing. First up is income. This is the money coming into your business. Second, expenses, the money you spend to actually operate the business. Third are your assets. These are the things your business actually owns. And fourth, liabilities, the money your business owes to others. Boom. Every financial discussion you have with an investor is going to center around how you manage the balance between these 4 pillars.
But listen, there's a golden rule that supersedes basically everything else, a phrase you're going to hear endlessly from the experts. Cash flow is king. Let me give you a quick scenario. Imagine a business that creates a massive invoice for a huge project. On paper, they just recorded a massive profit. But the client has 90 days to pay, and the business has to make payroll and pay its suppliers next week. The money leaving the business is moving way faster than the money entering the business, so they have profits on paper, but terrible cash flow. This is exactly how startups die before their next funding round. Cash flow is the actual physical movement of money in and out of your business, and if you don't manage it, you won't survive, period.
Now we reach Section 3, proving your health.
So you've talked the talk, but this is the stage of the pitch where founders actually have to back up their claims with hard, undeniable proof. You can't just tell an investor your business is healthy, you've got to show them. To tell the complete financial story of your company, you'll rely on the holy trinity of financial statements. Step 1 is your profit and loss statement. This report shows your income, your expenses, and ultimately your profit. Step 2 is the balance sheet, which details your assets, your liabilities, and your owner's equity. And Step 3 is the cash flow statement, which tracks the actual cash entering and leaving the business. When an investor asks to see your financials, they are asking to see these 3 reports. Together, they act as a comprehensive health check for your whole operation.
Underpinning all of those statements, though, is your budget. An investor really wants to see that you separate your costs effectively. You have fixed costs, like rent and salaries, which stay relatively stable. Then you have variable costs, like materials and shipping, which bounce around with your sales. The absolute necessity of a budget here literally cannot be overstated. You have to track every single expense, because even tiny unnecessary leaks will steadily sink your profits over time. A really good rule of thumb to defend in front of investors is this: if a cost doesn't directly help make or save money, cut it.
Let's move to Section 4 and see how this builds. Metrics investors interrogate.
Having your statements in order is great, but investors don't just quietly read reports, they aggressively question the key performance indicators that dictate your future growth. Here's the list of critical metrics you absolutely need to memorize. These are the exact numbers investors use to measure your performance and ultimately make their funding decisions. They'll ask about your ROI, or return on investment. They'll want to know your ROE, the return on equity. They definitely need to know your break-even point, exactly when revenues will finally cover all your expenses. And perhaps most importantly for early-stage startups, they will fiercely interrogate your burn rate and your runway.
Let's zoom in on burn rate for a second. This is simply the speed at which a business is spending its capital. Investors look at this to see exactly how fast your startup is bleeding through its cash before generating a positive cash flow. If your burn rate is too high, it's a massive red flag signaling to an investor that their capital might just get wasted on inefficient operations.
So the crucial point here is how burn rate ties directly into your runway. Your runway is the literal amount of time until the business completely runs out of cash. Think about it. If you have $100,000 in the bank and your burn rate is $10,000 a month, your runway is exactly 10 months. It visualizes the exact amount of time a startup has left to survive. If you're pitching for funding, you're almost always pitching to extend your runway so you have the time you need to hit your next major milestone.
Finally, we hit Section 5, securing the ask.
We are entering the final phase of the pitch deck arc. You've proven you understand the numbers, you've shown your health, and now it's time to talk about getting the capital and managing it responsibly. Every business needs capital, and you've got several avenues to get it. You can fund through personal savings, business loans, outside investors, or even crowdfunding. But there is a golden rule to follow before borrowing or raising a single dime. You must create a financial plan and calculate your expected return on investment. Never, ever take on debt without understanding the true cost of the interest, and never take investor money with a rock-solid strategic plan for exactly how it'll be deployed to generate a return.
Now, what's really interesting about this slide is the good news. Modern founders don't have to do all this manually with a calculator and a notepad. Notice the ecosystem of tools here: QuickBooks, Xero, Stripe, Expensify, FreshBooks, and Gusto. These platforms allow you to automate your accounting, your invoicing, your payroll, and your reporting. Utilizing these tools isn't just about saving yourself time, it's a massive signal to investors that you run a tight, modern, and highly organized ship. It proves to them that their money's going to be tracked with absolute precision.
We'll wrap up our explainer today with this pretty provocative thought. You don't need a fancy finance degree to master these concepts, but you do need intense discipline. Start small. Track your income, control your expenses, monitor your cash flow, and review your numbers every single week. Because when you stand in that boardroom, investors are really just trying to figure out one thing. Are you simply running a business, or are you actually building long-term wealth? So ask yourself, when you step into your next pitch, which story will your numbers tell? Thanks for hanging out with us for this explainer, and we'll see you next time.